Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're also going to talk about jobs and the economic fundamentals and all that fun stuff. And for that, Michael McKee is joining us at Bloomberg Economics. No, you're not Bloomberg Economics. What? Senior policy correspondent.
Well, economics and policy.
I mean,
he does all
policy.
things.
He's
all
a
things
long
here.
title. Like, that's the thing.
Boston Red Sox analyst for surveillance.
I mean, there's that too. Mike, I got to ask, are you surprised about the depth of the reaction? Like, people starting to talk about a 50 basis point cut in September, terminal rates being revised lower, the bond rally.
I don't ever get surprised by market reactions.
I love it.
And I've said this. I've said this before, and I'll say it again. The Fed has a reaction function. The markets have an overreaction function, and they always go too far, too fast, and then they come back a little bit to sanity at some point because you get a herd instinct when some kind of news breaks, and the markets were leaning towards a bad report, and so this just push them in a direction they already wanted to go. And I'll leave it to smarter people like Jess to tell you why they wanted to do that, but and whether or not lower rates are going to be good for equities or not. But at this point, I think it's today you just kind of look past what happened in the markets, and Monday you come back.
We can't do that. This is the fun part for us, but go ahead. Fair enough.
Well, Monday you come in and you start thinking about what does this mean for the overall economy. I'm telling everybody take Saturday and Sunday, just chill.
Don't call me in.
Yeah.
Well, we'll have actually Austin Goolsbee will be on Bloomberg Television noon, I believe. That's on our EcoGo page here. So when it comes to someone like that who's obviously on the Federal Reserve, what are you looking to potentially hear from him, and what do you want to kind of gauge here now coming out of obviously the Fed decision? And because he, at the beginning of July, he was kind of one of the first people that really, we know he's dovish, but he started indicating that he felt like cuts were coming pretty soon.
Yeah. Well, the chairman was very certain during his news conference that everybody was in agreement that they should pause. And I'm wondering if that's exactly true, or if he was maybe seeing what he wanted to see. And obviously the market is saying today that the Fed made a mistake. So do they think, how do they defend themselves to the idea of a mistake? And does this lock in September? And obviously, what do they think of a 50 basis point move? I don't think it's something that they want to do, so I don't think that'll be a big deal.
I mean, I know that the markets overreact and the Fed I get all that. But if the market starts to price in a 50 basis point cut or even an intermeeting cut, then the Fed has the enviable job of having to walk back expectations to kind of get that out of the market. How do they do that when they also have to acknowledge like things are getting weaker?
That's why they don't want to do that. They wouldn't do an intermeeting cut unless there was some real collapse in the economy, and we did get 114,000 jobs,
exactly.
which is
We're
not
not
a
falling
terrible
And the Atlanta
number.
Fed GDP now for the third quarter is
it's
like
what the
around
Fed had
2.5%.
been looking for. They'd been looking for a more gradual ratchet down. This was a fairly dramatic move, but it's not out of it's not an abnormal result for the economy. And the unemployment rate is 4.3%, and that's still historically low. So, yes, things deteriorated perhaps more quickly than they anticipated, but they're not going to panic at this point.
Okay, Mike, actually stay with us. Hang tight for this segment. We're going to bring in Joni Biley. She's Chief Workforce Analyst at EmployBridge, joining us now from Florida. Joni, give us your take on the numbers. Like, they weren't terrible. I understand the job market's slowing, but what's your take?
First, you can see that we have a cooling job market, and it's been coming for some time, over the last really even 18 months. Most of the job growth has been in the healthcare sector, in the government sector, and in leisure and hospitality. but there's been many sectors that haven't been adding that robust job growth. Manufacturing, professional business services has been struggling. The temporary help sector has really been struggling. So I think we're seeing more of the same, but this report showed some signs of real weakening. When you look at the unemployment numbers, that is certainly what concerns me the most, that we ticked up to 4.3%. We're up to 7.1 million unemployed people in the United States. And right now, I can't tell you that that's going to change very quickly. I think we're going to see more of that for the rest of this year.
What, if any, when it comes to inflationary costs, are driving people to go back into the workforce?
Oh, I think you are spot on when it comes to that. We are seeing people enter back into the workforce. So that is a good sign. Even labor participation ticked up to 62.7%. So people are coming back. They have to come back to work. And that is due to inflationary costs. We're seeing people not only, need both parents maybe to work in a family, but some taking second jobs, looking for part-time work or maybe gig work to kind of supplement their incomes. So yes, unemployment will continue to grow as we start to see more people participating in the overall workforce. And unfortunately, job openings are starting to decline. Month over month, I think we're down to about 8.1 million job openings, and now we have 7.1 million unemployed workers. So, there's still more jobs than there are unemployed people, but that gap is really narrowing, and it could reverse, that we will have more unemployed people than we do have open jobs in the US in the next couple months.
One thing we saw in the report today that would be ordinarily even a red flag is a drop in temporary help services hiring. Basically, are you finding that companies don't want to add anybody at this point?
Yes, unfortunately, the temporary help sector has been hit the hardest over the last 2 years. We've been seeing declines in job growth for, I think since March of 2022. So again, this month is concerning. There was a loss of 22,000 jobs in this sector. And, it really points to employers are going to let their temporary workers go first and try to hold on to their permanent staff before they need to lay them off. And it has a profound impact on the overall temporary help industry. So there has been a softness across the board. Certainly I see it at EmployBridge. I'm also the chair of the board for the American Staffing Association, and I can tell you the entire industry is feeling it across the board. We're hopeful, as we look at coming into the holiday and the peak season, that employers are going to start adding to their payrolls, and hopefully 2025 is a much better year. But it would point to a challenging economic climate right now, and certainly concerns because employers are not adding temporary workers, to their payrolls.
Where are we still seeing bright spots within the labor force, Joni?
Well, bright spots, I will say, can still be in that healthcare sector. There's a tremendous amount of job growth in healthcare, and I expect those trends to continue. We have been seeing construction jobs start to come back. And if you look at the horizon, I do expect that we will see a resurgence in manufacturing. We're just not seeing that right now, but many plants are being, built across the country, and those jobs will come back in the US. I also think if you look at the breakdown of unemployment, certainly having education, college degree, puts you in a much better position. My concern in this month's report was actually those lower wage jobs, really not coming back and being eliminated. And when you look at unemployment, we saw the largest jump in unemployment in 25 years of age and older for individuals that have not completed their high school diploma. It went up almost a full point. We saw that shoot up to 6.7%. So those low wage jobs are certainly being impacted. College degree, it's still down to about 3.5% unemployment, so certainly lower than that 4.3%. So education, skills, experience, those jobs are still out there and in demand.
Is this something, the situation we have now with employment, that a Fed rate cut is going to fix?
It will certainly help. I think most employers right now are being very focused on, cost containment and where they're investing, and with where interest rates are right now, their purse strings are just a bit tighter. So when we talk to our customers at EmployBridge and certainly employers across the board, they are saying that they are waiting, for the Fed to cut rates, and that they're hopeful that when that happens, things will start to pick up and they will start to make those hiring decisions again and move forward. So I would say from everything we're hearing on the front lines, yes, that will help.
Joni, we only have about 20 seconds left, but we've seen when it comes to women and entering the labor force coming out of COVID, it's been a bit of a struggle more so compared to prior to that. But what are we seeing on that front?
Yeah, I think that there's more flexibility for women in the workforce right now than there's probably ever been before. Employers want to hire, a diverse workforce. They want women to come back. And they're offering more flexibility. So options are out there.
All right.
And I do think we're seeing women enter back as well.
Great to hear. Joni Biley, Chief Work Analyst here, and apparently the Chair of the American Staffing Association. And of course, Mike McKee, over our own at Bloomberg here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bloomberg Intelligence Radio. Alix Steele, Paul Sweeney's off on the beach. Jess Menton is here, as well as John Tucker. Yeah, we haven't seen those chunky moves in the bond market in the front end since, guess when? 2023 March. Little SVB action there. So just for perspective on like the type of sort of panic buying, if you will, coming into the front end.
Also, though, Atlanta Fed GDP now for the third quarter coming in around 2.5%. And then the ECFC function in the terminal, that's where you can see the economic forecast for GDP annually as well as quarter over quarter. Still seeing strong growth here. Yeah. So I know people are potentially spooked by this job number coming in below 150,000. But again, when you're looking at some of the economic projections here, still pretty strong growth here overall for the U.S. economy.
It's such a good perspective, which begs the question then, when you have a sell-off that's triggered by that growth scare, what do you do then when the underlying data is still okay? Well, Matt Stuckey is Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management, and he joins us now. So to that point, when you see the NASDAQ off 3%, do you buy the dip?
Well, good morning. Thanks for having me. Look, I think before you rush into any kind of buying and selling activity on a day like today, revisiting kind of where you're at from a risk allocation is probably where you need to start. And so if you're way underweight risk assets, maybe today's a better entry point. But again, I think it's important to always kind of center whatever trading activity you make based on kind of your long-term risk tolerance, because that's likely to be tested in the coming months.
So how are you advising clients to position? What are you suggesting that they buy? What are you suggesting that they sell when it comes to equities?
Yeah, within equities, look, I mean, we have been somewhat vocal about our concern about concentration building in the S&P for the last year or so. And to kind of counteract a little bit of that growing risk, we've recommended clients kind of use a little bit of a value tilt within their portfolio in the S&P space, maybe an equal weighted exposure as well to mix in some diversification. We also have been somewhat positive about the optionality that we think exists in U.S. small caps and mid caps, where, from a valuation perspective, prior to July, things were fairly compressed and dislocated versus the S&P. And we thought it could work in a variety of economic outcomes, one being a mild recession, which kind of catalyzes some aggressive Fed rate cuts, or a soft landing scenario, which still allows the Fed to cut maybe just by less, that broadens out the economic participation in today's economy. At this point now, though, I think we got to have a longer term horizon for that to play out, because it does look like incrementally the labor market is accelerating to the downside, and we're likely to be in some choppier waters here for the next few months.
So you mentioned the Russell, and now we're looking at the Russell down over 4%. We haven't seen this kind of slide since June of 2022. I mean, I appreciate that it's looking for value is interesting. How do you manage then? We had a minor run up, and then here we are down again the most in 2 years.
Well, we're talking about our within equity allocation. I think it's important for your listeners to understand that within the global context of our portfolios, our aggregate equity position has been underweight, with a preference for high quality fixed income. And so we're thinking about a little bit of offense in that part of the equity portfolio, because we have a defensive position in fixed income, which is, in a day like today, really proving its worth from a diversification perspective. So, our message to clients on days like today is that this is likely to be the environment we deal with for the next few months of volatility back and forth, especially in areas like small caps, which not only have higher cyclicality but also higher beta associated with them.
Matt, something I'm curious about is whether or not, especially because Powell did signal that rate cuts could come as soon as that September 18th rate decision here. But Bank of America actually had some interesting data that they put in their flow show for Michael Hartnett this morning, where the S&P 500 has advanced more than 30% in the past 9 months, compared to an average gain of just 2% and a dozen prior occasions since 1979, leading up to a first rate cut. So I'm kind of wondering, when you have such a big run like that in risk assets, how much of that was a sell the news, especially because of small caps and that run up to what Fed was signaling there, Matt?
I thinking through kind of prior cycles and kind of connecting that to kind of what the Fed has been doing. Look, it's not uncommon prior to the first rate cut for markets to rally and make new all-time highs. However, to your point earlier about the sell the news kind of message here, rate cuts, when they happen for a response to a declining macroeconomic situation, which looks like indeed, if it starts in September, that's what the Fed is going to be using as their rationale, have a very different equity outcome versus rate cuts that are accompanied with a soft landing. And so we'll have to wait and see which economic outcome we get, but it certainly kind of ratchets up the risk profile in the skew of outcomes if we've had so much of a run up into that first cut. And from my perspective, it's somewhat of a valuation-driven rebalance there.
When you mentioned fixed income, where on the curve do you think still provides the most value on a price appreciation basis?
Sure. I mean, this is kind of the more recent kind of area that we've changed our fixed income allocation. For the last 4 or 5 years, we've been underrate duration-wise. During 2023, we moved our duration back into kind of alignment with the Bloomberg Barclays Act, in between that 5 and 6 kind of year range. And most recently, a couple of months ago, we extended even further to an excess duration position in our fixed income portfolios, with a very high credit rating of AA plus. In that position. We accomplished that just with a small position in TLT in our model portfolios, which moved our duration out a year or so. The thought there is that, as the Fed is starting to ease policy, as inflation is less of a headwind to fixed income pricing, this is a position that's a really nice diversifier in an environment like we're dealing with today.
All right, Matt, thanks so much for joining us. Really great getting your perspective, especially on a volatile day like today. So Matt Stuckey, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management, joining us on Zoom from Milwaukee, Wisconsin.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
So let's get to the economic part of this. Bill Lee is chief economist at Milken Institute, and he is joining us now. Hey, Bill, the market is taking this jobs report as like a total disaster, like a complete growth scare. Is that the right way of looking at it?
I spent my entire career warning people not to overreact to one data point, and it looks like the markets are continuing to do that. Markets never disappoint in always overreacting. And right now, all I can say is that how can you have a recession when the unemployment rate is between 4 and 4.5, which most people think is where the natural rate is supposed to be? The second thing is that the numbers are showing that the unemployment rate has gone up because the labor force has grown more than the population. The layoffs are starting to mount up this month, but this is the first month of layoffs that we've seen. So for me, I think the recession calls and the fears in the markets are way overreaction.
And I'm glad you brought that up, Bill, because Alix and I earlier were talking about the latest Atlanta Fed GDP now number for the third quarter coming in at 2.5%. And as you know, that those numbers can be volatile, but still, when you're looking at kind of the trajectory here for economic growth, still looks pretty solid. When you're talking about the dynamics within the labor market, and particularly the participation rate, how much does that play into, especially when you see a number drop like that, as far as who's coming into the workforce and who's leaving it?
That's really critical, Jess, and I'm glad you brought that up because as much as people point to the SOM rule and the unemployment rate rising as being a recession indicator, a lot of indicators and historical relationships like that have just not worked so well. How long has the yield curve been inverted, for example? And people have said, "Oh my God, that's always a good indicator that we're in a recession."
Right.
So I think we have to look carefully at that composition of the labor force, and what we see is that immigration and other factors and people just wanting to work now because it's easier to get to work, and there are more jobs readily available. So people are encouraged to participate and try to get more jobs. Now, the bad part about this is that consumers have been spending like crazy, as we know, and savings rates have been dropping. Now, the rich people have been dipping into savings, but the median worker and the lower half of the population have really been resorting to a lot of credit in order to make ends meet. And part of that making ends meet is getting a second and third job, because most jobs that are available right now are in leisure, hospitality, and sectors in the economy where wages just aren't that high. Mm-hmm. So for me, the real problem out there is the growing bifurcation in the population of rich and poor. And I think we're going to start to see more and more of that as we go toward the election.
I mean, yeah, that K-shaped recovery or economy just keeps getting more K-shaped. Your old alma mater, Citigroup, came out with their call. It's 125 basis points for this year in terms of cuts, 50 in September, 50 in November, 25 for December. That feels like one of the more dovish calls out there. Do you think it's an economy that needs that kind of move?
Well, I'm glad we're not there anymore, because the need to attract client attention is something that I don't need to worry about anymore. And I feel sorry for Andrew Hollenhorst, who's still in the business of trying to distinguish himself from every other economist out there. I think that's a bit overboard. From my experience at the Fed, I think the reaction at the board and among all the district banks, they'll be saying, we're normalizing the economy. The need for large number of rate increases is really not there. And if we were to do it, it would signal to the markets that there's something to really worry about and that we're panicking. And the need to panic right now avoiding the impression of panicking right now is, I think, paramount for the Fed. So I think we're going to see 25 basis points in September, and maybe if the data continue to deteriorate like this, they'll talk about a more continued set of rate increases and probably hint at 3. But if the data starts to turn around a bit and stabilize and normalize, and we don't see an acceleration in the worsening, I think they're going to say, possibly 2.
Where do you see average job growth coming in over the next 12 months with the expectations that the Fed is going to begin its rate cutting cycle?
Yeah, I think when we look at where the payrolls are weakening, it's exactly in those sectors where the Fed wants it to weaken, the interest sensitive sectors. In fact, one surprising part of the numbers is how strong construction continues to be. But I think the Fed is going to start saying, if we are successful in normalizing interest rates and normalizing the economy, we'll see payrolls and household employment grow somewhere in the 100,000 to 120,000 range. That's normal. And so everything we've seen up until now at the 200 level is way above normal and not sustainable.
Here's my broad question, also how it relates to tech. Hyperscalers are spending gazillions of dollars, that's a technical term, in terms of spending for AI. Can we have a meaningfully weaker economy with that kind of CapEx spend?
Great point. Because as we see in the numbers this month, one of the surprising sources of job decline, payroll decline, is in information systems. Now, fortunately, most of that, or almost half of that, is because of broadcasting and newspapers and publishing. But there is a component that talks about where the hyperscalers are. And that also shows a small set of job, the payroll declines. And I think what we're seeing is that companies are having to rationalize their finances and to say, if we're going to spend a lot on CapEx, that means that we're using capital, AI, and other types of innovations to substitute for labor, and especially labor that's very expensive labor. So right now, if you don't have the right skill set in the IT high-tech industry, your jobs are on the line, because you're going to have to prove to the employer that you're going to be a value-added producer going forward in a world where AI threatens to take over a lot of the skilled jobs. Skilled jobs like, entry-level programmers, where software itself is being written by the AI software that's being installed.
So with Jackson Hole obviously coming up at the end of this month, so we'll have a lot of different Fed speakers between now and then in the next few weeks. I know Alix is excited about that. Obviously, that September 18th decision being the next meeting for the Federal Reserve will decide on rate cut expectations. But how many rate cuts are you really forecasting either for this year or over the next 12 months? Because like we've been talking about so much, Alix and I, the economy's still strong. I mean, it doesn't seem like this is going to necessarily need to be an aggressive rate cutting cycle like something you would have seen during the pandemic or the great financial crisis or coming out of the dot-com bubble bursting here, with the economic growth still pretty sturdy here. So what are you foreseeing here?
That's a great question, because I think the real onus on Chair Powell now is at Jackson Hole to calm the markets and say, we're not in a recession, we're not panicking, we are in a normalizing situation. That has to be his primary message. And in doing so, he will try to hint more at the expect 2 cuts, possibly 3 for the rest of this year, and nowhere near the levels of 50 basis points initially, and we'll front loaded with the equivalent of 2 cuts, and we'll have to continue with 2 more for the rest of the year. That would be the wrong message to send, because right now markets are way overexcited about the possibility of recession. I think his job in Jackson Hole will be to calm the markets and calm expectations, and to restore a sense of historical perspective as to what is normal and what is a normal Fed reaction to what's going on, which is moderating interest rates, because they are restrictive right now. There's no question, but we don't need to panic and cut them so aggressively.
All right, Bill, we appreciate it. It was great to talk to you again. It's been a while for me. Bill Lee, chief economist at Milken Institute. Really good to get that perspective. So sort of walking that tightrope then of having to work back some expectations now for more Fed cuts, but keep showing that the economy does need a little bit of support. That is another kind of tightrope balancing that the Fed's going to have to do over the next few weeks.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics. And we are live from our Interactive Broker studio right here in Midtown Manhattan. Also, check us out on YouTube. All right, you just heard a market check there. It is ugly out there. I go back to Cameron Kreitz, the macro man. He writes for Bloomberg that says, who's going to save the market? Help me, Obi-Wan. You're my only hope. Who's the only hope? Is it going to be NVIDIA? Is it going to be Powell? Is it something else? Ben Emmons is Chief Investment Officer and founder at FedWatch Advisors. He joins us now. Ben, what saves the market?
Yeah, it would be the Fed. If I say FedWatch Advisors, because this is clearly a loud call for 50 basis points cut right now, right? Because of this weak payroll data. Then again, the drill in the report, it's a lot about technology jobs. I guess that's what Powell really said. It's like the lags are showing up in the economy, right? The variable lags of policy, and technology gets hit by that the most. And guess what? That's also down the most today in the market. So I think, Alix, is a 50 basis point cut that the Fed would have to deliver. Of course, it's not going to do it, but I do think that this report sets us up for the September meeting now for sure, as Powell sort of signaled it. So markets will eventually rebound from this. It looks like to me they were obviously overshooting to the downside, both yields and stocks.
And especially coming off the back, as you know, been from Powell signaling that those rate cuts are coming as soon as September here. I mean, how much of this really changed from the last 48 hours? Because obviously we did get that manufacturing data yesterday. Of course, we had the jobs data this morning, but we already saw this decline really ramping up yesterday after a huge bounce and a huge rally with the NASDAQ up around 3% on Wednesday. And obviously the S&P 500 posting its best Fed day in about 2 years here. So how much of this is kind of like a re-rotation here, moving into other corners of the market when you had speculative areas like small caps really get ahead of themselves, especially in July, and now moving maybe toward these kind of dividend paying corners of the market here?
Yeah, I think you're totally right, Jess. There's a really nice rotation function on the Bloomberg terminal that shows exactly that. You see precisely that rotation playing out the sectors that you describe. So it is also about that people look at this like, there's an election playing out here too. Harris catching up really quick to Trump in the polls, raising a lot of money. So the Trump trade is fading, and that Trump trade was very associated with small caps against a backdrop of an economy that's just softening. I don't think this is the 2007 suddenly we're in a recession moment, right? With back then the idea. But I do think the yield curve steepening indicates like, the economy is on a much slower path and you're getting lower payrolls. And small caps don't do that great initially on that type of news. So it's a combination of two. But I think that rotation will continue. That's why I think that the sell-off in tech stocks is probably getting overshot to the downside, makes these stocks oversold, and that's why I think you can expect a rebound coming in once things settle out.
When you mentioned this is a clear call for the Fed to cut, like right now, and we've gotten calls for 50 basis points now from Citi, JP Morgan. You also mentioned that. I guess my dumb question here is why? I mean, I understand that the report wasn't great. There's obviously, you can look at some potential seasonality, like the permanently unemployed people. A lot of them were temporary unemployed in terms of the overall number. You could also make an argument that there is a weather factor, even though I understand some of the headlines showed no. But why the urgency?
Yeah, that's the puzzle a bit, Alex. Like, why that sentiment shift suddenly? But I think that people are looking at maybe the accumulation of data, right? So claims are steadily rising. The 4-week average is steadily rising. We're closer to that somber trigger, not exactly. Mike McKee had a nice spreadsheet this morning on the show, and he says like you're just a tenth or whatever % away from that trigger. But I think that is the psychology ultimately. Even if Powell says that rule is just a statistical measure, nothing else. So it's psychology here that plays a role, and ultimately it's about like the Fed can cut rates and it could remove more of the restriction. And if you drill in the report, as you say, there's definitely reasons why you don't have to cut with like slashing rates, because let's face it, you also have strong job gains in healthcare and construction and financial activity, and leisure, which have been engines of growth in the economy the last several years. So that's not where the weakness is. It was really the technology jobs in itself. So I think it's more about psychology that we're Fed, you're behind the curve, you got to move. Why people are trading the 50 basis point cut, which, as we know, is unlikely to be delivered in September, more like 25. So it's more like the Fed now gets enough evidence to remove the restriction of this policy, and this report just cements that goal for that.
And to Alix's point, JP Morgan, Citi, seeing basically these Fed dealing 2 half-point rate cuts, but then also you have Goldman Sachs over there. They added a 3/4 point rate cut in November to their prior forecast. Also, Bank of America, who had been holding out for rate cuts in the beginning of December, they said they now see to look for the first move in actually September here. So when you're looking ahead over the next couple of weeks for other indicators when it comes to the economy, next week's a little bit lighter on the economic calendar, but we still have some services related data coming out as well. But then the week after that, obviously, we'll have another update when it comes to CPI on August 14th. So what are you looking ahead between now and then? Because next week's also a huge earnings week, still on the back of coming out of these big tech earnings, because you have a lot of consumer focused names that are going to be reporting.
Yeah, I would look at those, because that's where I think the issue is currently, right? If you look at the current sell-off today in the S&P, what's the worst performing sectors? The consumer discretionary, right? So I think that's where the economic pain point is currently today in the markets. So these earnings from these consumer companies are obviously key to watch for any kind of significant demand slowdown. McDonald's was, I think, a kind of a wake-up call earlier this week of that it showed like, these consumers aren't so out there, eating left and right everything, and are more conservative. or getting more conservative. So I think that was the first precursor of what the consumer sector is really showing. That is the slowdown that we've been anticipating against the sentiment that you once again highlight. It's amazing, right? All of a sudden, we're getting a weak report, and every bank jumps all over one another to add more rate cuts. While at first they were reluctant to put out rate cuts, right? So I think it's that combination of that bit of the, exaggerated sentiment that we know over all these years of analyzing markets that always happens after a payroll report against the true economic environment, which is slowing. But I don't think this is the recession moment. But we definitely have to acknowledge that the Fed is probably over-tightening here, therefore they can change.
All right, Ben, we got to leave it there. Thanks a lot. Ben Emmons joining us there from FedWatch Advisors. He's the founder and CEO of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get to Amazon. Is it a tech company? Is it an e-commerce company? I feel like this is always the question. Poonam Goyal is joining us. She's senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. Amazon stock is down by about 12%. I know it's a tough tape, so it's hard to really parse out. But Poonam, help me understand why the decline in Amazon.
The decline is largely due to the operating margin guidance, which came in below street expectations as they're investing more in CapEx, which is really on the AI side to support the cloud business. Now, you could argue that they did also talk about the consumer and it being weaker and it trading down. But I think, when the consumer trades down, Amazon can still do well and take share because they press the pedal on price and convenience pretty hard, which draws them the attention that they need.
So when you look at Amazon, an MOV function, MAZN is a ticker symbol on this. So like Alix was talking about, down 12%. It's actually the worst performer in the S&P 500 and also dragging down the communication, the consumer discretionary sector down over 5% right now. So when it comes to, especially when you think of spenders that feed into NVIDIA, because that was something that when it comes to those customers, because we won't hear from NVIDIA until August 28th. So a lot of people coming into this week were looking toward NVIDIA's customers because if you looked at, say, Amazon or even Meta, Alphabet and others who, if you combined their CapEx spending over the prior 4 quarters before this earnings season, it was around $150 billion. So the thing was, will they pull back or not? For the most part, we still saw a lot of spending. So I'm kind of wondering from that equation, Poonam, what are you seeing there as far as what this could potentially mean for a stock like NVIDIA? Because obviously this is more of a discretionary type company when it comes to Amazon, but when it comes to the spending, how do you parse that?
Sure. So for Amazon, the one thing you have to keep in mind that they were behind the AI wave, right? So they're investing more into AI than maybe some of their peers. And we think that's the reason that you're seeing a tick up in the second half from 30.5 billion in the first half. Now, when it comes to some of their counterparts, they've been ahead of the curve and they could, depending on where their sales come out and where consumer demand is, they could continue at a steady pace or even pull back a little because they are somewhat ahead of the curve.
This is a super basic, dumb question. As they ramp up their AI stuff, how does that help them with e-commerce? Since that's such a huge chunk of their business. Like, I know that the AWS is the sexy growing part, but when you look at revenue, whether it's e-commerce or online stores, it's still double what AWS brings in. How does AI help that?
AI is actually a big, big deal in the retail space and the e-commerce space. So when you think about AI, what it helps them do is it helps them across all facets of their e-commerce business, whether that's search, right? So you go into the Amazon search bar, and let's say, you're used to typing in, I want a black dress, but now you don't have to. You can say, going to a black tie event, right? And they should be able to populate dresses that go with that. So conversion is one of the biggest pain points in e-commerce. You're going online to browse more than you are to buy, whereas you're going in store to buy more than you are to browse. So I think as what AI can do in a meaningful way is improve conversion because you can get the results that you're looking for faster. You can improve the shopping journey. You can get customers to find what they want more easily. And not just that, right? They're using AI not just for the search, but they're using it in customer service. They're using it for inventory. They're using it in their automated shopping platforms like the Rufus or the Alexa. So there's a lot that's happening with generative AI, especially, which we think will help drive retail higher for a long time.
We only have about a minute left here, but you've talked about also how when it comes to the margin equation for Amazon, how you're seeing that expanding over the long term. And as you know, Alix, when you think of the discretionary sector, the margins coming out of COVID, that was such a big issue because of the inflationary pressures. So I'm wondering, Poonam, when you're thinking about that, because if you're not an Amazon or maybe like a home durable, like a Home Depot, a lot of those other retailers are struggling. So what are you seeing from like the margin aspect, maybe more broadly, or what can Amazon tell us kind of moving forward, what that means for discretionary type of companies in the retail space?
Sure. So remember, Amazon's a retail company, but it's also a tech company.
Right.
And the margin opportunity for Amazon really comes from the tech side. So the cloud business, which is about $100 billion, we estimate that going to $200 billion with a 40% margin. There you go. You just added another $40 billion in profit. And then when you look at the when you look at the advertising business, $50 billion run rate going to $100 billion, which we think carries higher margin than AWS, you're looking at adding about another 50 billion at the minimum or more in operating income. So right there alone, you're reaching about $100 billion in operating income in the next 5 years, additionally to what you have today. And that's the profit driving part of Amazon. And you can argue that ads are supported by the growing retail business.
Poonam, we got to leave it there. We're up against a break. Thank you very much, Poonam Goyal, Senior EU.S. Commerce Analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. So the latest right now is that Citi adjusting its Fed rate call. They see a 50 basis point cut in September and November and 25 basis points in December. So things are moving fast and furious. What's also moving fast and furious is Intel stock. I just want to start there because it's whenever you have a company like Intel mention something like liquidity very high up on their earnings, that's never really a good sign. That stock is now plummeting 28%. I want to bring in Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. He can also hit on Apple as well. But Anurag, what happened here?
Yeah, I mean, Menton is going through a restructuring right now. So this is just a fallout from that because remember, right now, data center is where all the investments are going in, and NVIDIA GPUs is what everybody wants. So that's really not playing in the sweet spot of what Intel does. Big turnaround story, and it seems some issues there.
And as you know, that stock has already been under tremendous pressure this year alone, too. So usually when there's cost-cutting efforts, when you hear those kind of magic words, usually investors will gravitate toward that, especially when you think of, say, as you know, Anurag, Meta at the end of 2022 when it first announced its big tranche of job cuts and cost-cutting efforts. But with this, and especially the intricacies that you were just talking about, what exactly is it that investors need to see in order to have more conviction for a stock like this?
I think sales growth needs to pick up because at the end of the day, unless you see that, that's not going to translate into, cash flows and bottom lines. In the case of Meta, there was excess spending, but at the same time, their digital assets were still being used very aggressively by public, whether it's Instagram or WhatsApp. And there is no shortage of assets over there. So two different and distinct stories in the tech land.
What do you make of Apple then? It wasn't terrible at all. If we're taking a look just at the equity market, considering the sell-off that we're having, Apple stock is actually up 2.4%. So
best gainer
impressive
today in the S&P 500.
Yeah, it was. You could say that tech is right. I mean, Apple is right now the cleanest story in tech land, only because they are not spending billions in capex. They are seeing some improvement on their top line, and with the promise of potentially a refresh cycle on the iPhone coming over the next 12 to 24 months. So things are looking good for Apple from on a relative basis when you look at companies like Amazon or Microsoft.
That's right, and especially because Apple, in the first quarter, it was worst performance relative to the S&P 500, one of its worst since the dot-com bubble burst. But if you look at where it was from mid-April to now, up almost 30% in that span. So even though there were concerns about China in this latest earnings report, still there's more optimism on the other side of that. So what improvements when it comes to China have you seen there?
Yeah, I think April is when the company came out and said that their numbers in China are not as bad as news agencies and analysts were making it out to be. And I think that led to a reversal of the stock at that point. And since then, they did a very big AI event, which surprisingly went very well. because Apple's been criticized over the past few years of not innovating enough. So I think those two factors really changed the investor perception of Apple in terms of as a company and its fundamentals. And now we are waiting for the iPhone 16, presentation, which is going to be somewhere around the September timeframe. And with that will come the next level of, you could say, hardware refresh cycle. So things are looking good for Apple, not so much for the other tech players at this point.
Before we let you go, I mean, I understand you said that Apple's not spending boatloads in the same way on AI, but don't we want them to do that? Like at some point, are they going to be behind on that then?
So think about it this way. People are dying to have their large language model on the Apple distribution network. They don't have to spend the money. OpenAI can do all of that spending. They will just license it and to have it on their phone. This is another way for them to say, why do I need to make data centers when I can rent the data centers whenever I need them? So they have a fairly different strategy when it comes to capital allocation as compared to the other companies.
All right, Anurag, super appreciate it. Thanks a lot, Anurag Rana, Bloomberg Intelligence Senior U.S. Technology Analyst, joining us.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.